Oh, no problem.
That's funny.
Yeah, so I was kind of laughing about it.
So how you guys doing? Okay.
Yeah, I'm a little under the weather. So I'm gonna let you guys do most of the talking.
Okay. Does that mean you're not gonna laugh at any of the jokes this year? This time?
Do what is it?
You're not gonna laugh at any of the jokes? Then?
I'll try.
What do you got? You got some goodies?
I was going to define the sectors inside the S&P 500, how they've been affected by oil and interest rates.
Good.
Kind of a little breakdown. It's going to be a little more historical.
Nice.
Good.
It's getting tough because the market's been moving so much to talk about performance or what's going on. It's been kind of crazy.
Right. I know.
So-
Other than it's either I want to get out or should I stay in?
Right. No, I mean, I think we did the question on that, didn't we? Or no?
Okay, yeah, your question that we have for you is, what do I change with my investments in this type of market?
Right.
So that's that. And Mark, yours is, are you seeing a switch in the types of loans being requested than you were doing last year? Are the markets changing?
Yep.
We can go live on Saturday if you want. Right, if you ever went live on Saturday. Do live on the air. Don't swear. Oh shit! What?
Yeah. Yeah, I had that a couple times. Not so much.
You did?
This show,
No,
not
the
in this
sports
show.
show. Yeah, we've been good. I've never
We've been
done
really good.
anything. I mean, I know you can say ass and ass hat and something. We never even do that.
No, we're pretty good about that.
Does the sports show been going okay?
Yeah, we just Bruce just left. We had Larry Kruger on. It was good. He does good. Does good radio.
Yeah. I'll tell you, I know a guy he worked for when he went out of business on KMBR the first time, and I won't say what that job was, but the guy here goes, "This is freaking work. What I'm doing now." It's like this is compared to being on the radio from 7 to 10 at night talking about sports all day. He goes,
Yeah,
"This is real work." He goes, "This ain't this is office work." He goes, he was it was tough. So, but you talk about the Giants or no?
We talked about off-season NFL moves,
Oh, yeah.
and then talked about some spring training stuff.
That's not a 9-10 though, right?
No, it's national. But they don't carry it on local stations here.
Okay.
There are a couple of hundred stations around the country that do carry it, like 910 or
Right.
KBR, and then it's like iHeartRadio and TuneIn. They say we have a couple 100,000 listeners.
So you must do it on the interweb, right?
Well, there's only some on the web, but most of it is really
Some
on
of these
the
podcasts we're picking up. It's just, do I use the white headphones? What Sony's?
If you use the other one, since you're on mic 3.
Let's see. We got this over the checker.
That's nice. We got good on timing here.
Where are we starting?
Okay. We'll just start with Lou.
Yeah, absolutely. Yeah. Well, last show was just he and I, so. It was,
How hard was that? That was brutal, huh?
Well,
Not so bad. No.
I mean, I can literally go into, I'll say autopilot, and it's really just, I can talk about the business in a way that I think is vaguely interesting. And I actually did get a call after that show by someone who said, it was someone who called up and said, "You said everything I needed to hear, about private money. It was really great," because I talked about, I went in and I said, and I just broke down the business model of, a lot of people hear hard money, they don't really understand how it works. And here's how it works. We talked about the borrower clients and then the investor clients, and what are the concerns of both, and how do I serve both clients, and then we talked about the two mortgage investing models of individual notes and mortgage
You got to
pool
dive
fund.
down deep then.
Yeah, and we've done it before a number of times, because we actually did 13 episodes of Mortgage Investing 101.
Just strictly on.
Yeah, where
Was
we
that the
bought an
other show,
additional
or
was that
hour.
KBR?
It was. Yeah,
Or
we did that. That was
NEW.
it was the over a year. Because we did the second half of 2013.
Yeah.
We did that.
Yeah,
And,
for 6
it got
months.
to be so much. It was like doing 2 shows a week, which is brutal. And then, especially when the holidays come up, then you got to do 4 shows. It's
Yeah,
like, kill me now.
And I did have 2 inquiries on. Remember, I said, if I put an invitation out there, I said, if you want to know what bank is paying 1%.
Oh yeah.
And, so I actually had 2 inquiries.
That's
on
good.
that, so. All righty.
Yeah, so I got a couple of deals of the week I can talk about. And, examples of people who come to us, and it's just not the kind of examples. That's something we talked about last week. Not the kind of examples that people tend to think when they think hard money. They think, oh, you're kind of in that predatory lending environment, and you're the lender of last resort. People go to you when they're in desperate need, and it's really not that. There are lenders out there like that, but that's not who companies like PPM and others. We serve a completely different clientele of need for speed or ease of financing. Anyway,
No, I get you. It's people.
I mean, a good example is like the one that Rick and I were talking to the banker, where she's got a low. Well, actually, maybe not that one, but the other one where she's got a really low first mortgage with a low interest rate, and you don't want to destroy that. And not that many people will do seconds, but it's a safe second. If you only have a $30,000 first, property's worth $1 million. But some banks, no, sorry, we're not going to do it. So you don't want to pay it off if it's 3% interest rate. So that's actually kind of a good example.
Yeah, it is. Well, I've got that.
All right, we got our cell phones on mute.
Silent but deadly.
Story of
No,
my life.
Yeah, that's true.
Not anymore. I've been good.
There's pills for that.
Nice. Everyone runs on them.
My dad's business partner was like that. He just had like the worst gas all the time, and it's like he would tell me stories that they'd be like going on business trips. They'd get into an elevator and he'd let one loose. So someone would come in, they'd walk out like right away.
All right. Okay. You guys ready?
Just finish up some final emails here. One silent. Okay. We get surprised by the trivia questions. This is kind of exciting.
Oh, and you know what I think?
I got one last week.
Yeah, you know what I realized too, and I can't remember. Maybe I was talking to Eva about this. What I'm going to do is I'm going to start giving you if you can't, because I don't want to embarrass you on the air.
Yeah.
I know sometimes they're fun, but sometimes it's like if there's one that's something that should be known, I'll just tell you what it is. Of course, this trivia one, you might get all of them though. Okay, you guys ready?
Ready.
All right.
Boom, boom, boom. Test. I can kind of hear myself a little low. Hello.
Hello. I can hear you good.
I can hear you. No problem.
All right.
So yeah.
All right, here we go.
Don't forget to lean away if you cough.
Hold on.
Sorry.
Oops. Gotta let him leave.
Yeah.
Silence.
You always tell me before I go on. Don't forget to lean the other way in case you cough.
That's right.
Don't you have a dump button? Come on.
No, not in this one.
Yeah.
And just remember, if you're talking to him, just go like this, just pivot, or just look at me and talk to him. Hey, Mark, how you doing? Okay, ready? Welcome. You're listening to the Best of Investing on Talk 910. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hahn of Pacific Private Money, one of California's fastest-growing mortgage investment firms, and Lou Batmale of LPL Financial. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during this show. And the vacations are not sponsored by the radio station, but by the Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. Their only request, they had to raise this now because it's getting too expensive. It's going to be a $100 cleaning fee if you want to actually use the vacation certificates, but that's okay. All right. Today's trivia theme is Mark's favorite Seinfeld episode.
Oh, right.
I'm in.
You're in? Okay.
I think I might even get one.
You ready? Yes, you will. Okay, our website is bestofinvesting.com. Check us out on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Now, Lou, you haven't been with us for about a month or so. What's been going on in the markets?
Sell now. Run away. Gold, silver. Buy yourself a hut on a beach and just call it a day. That's all. That's
Okay, that
been
works
great.
for me.
It's been a real enticing market lately. It's been a lot of fun, and I have fielded a lot of phone calls and got a lot of questions from everybody. What do you do? Where do you go?
Define fun.
Fun. Well, fun is the inverse of not fun. Not fun is the market's up a little bit and no one wants to talk to you. Like, everything's fine. My statement's great. I could care less what you're talking to me about right now. So it is fun to engage people and reassess where they're going, what they're doing, and how they're going to get there. Because people forget, they get lulled to sleep a little bit. And we've been in a pretty good equity market the last couple of years, actually.
Yeah.
And everyone's said, oh, hey, just let it go up and no problems. And once we get a test like we did over the last couple of months, back in August and September, and again this past couple months in February, wow, it really tests people's resolve, and they have to decide what to do. So it's very hard. It's very challenging.
Yeah, how often do you get people where you have to kind of remind them, look, we're looking at long term, don't just jump ship now?
Well, I remind them of their age, and lately everyone goes, well, I'm 70 years old, I have no age left in me, so let's just forget about this. But others, they do have to focus on the long term, that we're trying to hedge inflation. Inflation's not apparent out there right now. So that's one of the struggles, is that, we're trying to stay and outpace other costs.
But you don't stick your head in the sand. I mean,
you got to pay attention and reallocate your allocation to where you feel comfortable. And that's,
of course, there's no inflation unless you're talking about healthcare costs,
yeah,
which are actually going up so much on an annual basis. I read some crazy articles about it. That if that's the biggest portion of one of the largest portions of your budget, and it's going up 20% a year, it feels like inflation's like off the charts.
I think there's pockets, and that's kind of what I wanted to talk about today. In the world of investing, there's acronyms that are thrown out there all the time. And some define measurements, and some throw out there in the marketplace like everyone should understand what they are. Sadly, when I sit with clients, sometimes it's hard to define what a stock or a bond is to them. In today's 5-second world of newscasters acting as investment advisors, it's good to understand that what happens underneath it all and how to truly define something, which helps us you understand it better. I could ask you to name 2 provisions of your cell phone contract. What would those be?
How long a term do I have?
How many
Exactly.
minutes
And
per month?
how much does it cost?
Yeah, I said upgrade and 2-year retention policy. It's pretty much everyone knows about cell phone contracts.
Okay.
There's a lot of other provisions in there, but nobody reads. Nobody knows about. So there's all these different tacits or aspects to these things. You got to understand it. So, when you come out there and throw terms or acronyms out there in the investment thing, over the past few years, everyone's talking about the S&P 500, right? What's the S&P 500? It's basically an index, and it's a measurement tool that was developed a long time ago to measure your own investments against the general market. What's the general market? Well, that includes large companies, small companies, U.S.-based companies, and foreign companies. There's actually a governing board that goes over the S&P 500 and talks about what should be in it, what should not be in it, how much it should be weighted to every single stock in. There's actually 500 stocks in the index. However,
is that a coincidence? That's called the S&P
no,
500?
no coincidence. That's part of the problem. You don't understand what it is. And I like telling clients, like, look, the biggest problem you see inside the index is what they call index swell. It's kind of like owning real estate in one neighborhood, right? But San Francisco Bay Area is judged. It's a very expensive real estate market, right? What if you just valued Pacific Heights, or just Atherton, or just the Berkeley Hills, that's
just a Tenderloin,
or just a Tenderloin, exactly. Good point. And which is turning around the mid-market tapering again. Yeah, we can go to that all we want, but that's the challenge, is that there's different pockets that perform differently. And there's several companies to each and every index out there. But what I try to bring it down to is actual parts of the sectors inside the S&P 500, which there's 10. Okay? So there's 10 individual sectors. So real quickly, when you think of
automotive.
Well, you're capitalized in each one. So
Okay.
you think energy, materials, industrials, consumer discretionary, consumer staples, healthcare, to Mark's point, financials, technology, telecommunications, and utilities. All right, all different kind of companies. So I mean, you can talk about examples all day long as to what goes into each one of those sectors. But we look at the headlines nowadays. Think about it. The price of oil has dropped since February 2015. I have a chart here showing, we're not on TV per se, so I mean, it's fallen from about $63 down to $37 in last year. It was down as low as $29, $27 a few weeks ago. So what's that do? What's $40 a barrel do to the economy? What's it do to all those sectors? So when we look at it, it's really good news. You sell oil to those energy companies, and they're hurting because they're not making as much money because the cost of their product has gone down. That's really weak for them, so they can't pay their dividend or interest payments. So take energy off the table as a sector that's performing well right now, because it's not. It's really in a lot of pain. Then you look at other things out there, like maybe, consumer stocks. Well, think about it real quick. Who's spending less on oil right now? Everybody. I saw one study not so long ago, $1,300 goes into people's pockets when oil drops this much. That's a lot of spending dollars throughout the year to go spend on consumer discretionary items. Technology stocks get affected. I mean, someone might be able to afford an iPhone for once if they save that much money in gas. So this is how the economy is affected. Each and every sector is different. And we have some like healthcare that are skyrocketing, right? Because of Obamacare. That's actually noted in the Wall Street Journal from last year that all these healthcare stocks have actually jumped significantly because of the advent of Obamacare. Everyone has medical insurance.
So let me ask you about the $1,300 roughly.
Okay.
You know, it's not like someone writes one check to themselves for $1,300.
No.
It's kind of slow because you get gas every once or twice a month type of thing.
Right.
Or 4 times a month if you drive a lot. You know, how do people like really analyze that? You know, they don't look at. They go, I spent $38 last time to fill up my tank. Now I'm spending $19. I got an extra $19 to spend. I mean,
Well,
you
if
know
you
what I
truly
mean?
live on a budget, and many people do, and so if you budget in how many times you go out for dinner, and you budget in activities, movies, and other living expenses, and if all of a sudden your gas expense goes from $200 a month to $150, there's $50, and that may end up at a restaurant or in a consumer.
Well, that's a good point. Yeah, if
purchase.
you actually do a budget where you do
Yeah.
some shifting around, that's a good point.
Well, some clients actually have gas cards still. I know it's not that popular, but there's actually people who have gas cards out there, and they can actually monitor the bill and see that it's gone down by, for commuters, some as much as $300 a month, some as much as $100 a month.
Well, I put it on Visa, and Visa does
Does
that
every-
for me.
Yeah, and that's part of the problem is that that's a great example. So look at how that affects the financial sector right now. The financial sector is hurting a little bit because banks aren't making any money, right? But who is?
Well, no, the banks seem to be making
Bank
money
cards,
just
right?
The credit card companies.
Yeah.
Credit card companies are doing quite well. Now, what can affect that? Beyond everything else, interest rates
Yeah.
control credit card payments.
Yeah.
So does control mortgage rates, right? We don't know where interest rates are going. We've had
You said the banks aren't making money? I thought they were making lots of money, just
No,
hand
not as-
over fist because they were just lending it back to the government.
well, no. In this environment, what can you get a CD for at a bank?
Oh, I'm talking about the banks actually making the money, not we
Yeah.
make money at the banks.
No,
the
no.
banks themselves making money.
But no, the banks aren't making that much profit because they can't lend the money. They don't have a spread anymore. They're lending money out at what 4%, 3%, and they're paying you 1.25%, 1% in a CD. Where's the profit in that? They're used to giving you a 5-year CD at 4% and lending it out at 8 or 9.
Okay,
That's
so
much
the
better terms.
Spread went
The,
down a
yeah,
little
the
bit.
spread went down a little bit. It's compressed. That's and actually people aren't doing a lot with their money right now either. So that's caused another problem. But interest rates will affect people's spending patterns. They have less money because their second goes up in interest rate, right?
Yeah.
You guys know that.
Sure, yeah.
If you guys pay attention to credit card companies, when they increase rates or people's rollover balances and their interest starts accumulating, wow, spending goes down significantly on a lot of these credit cards.
Good point.
So that's something we're going to affect. That's going to affect everybody here real quick.
All right, hey guys, let's cut to our first commercial break here. The theme is Seinfeld episodes. Before we do, I want to make a little mention here. Are you guys ready for this? Adventure Connection. They have rafting trips where they do wine tasting one day and rafting the next.
That's awesome.
Isn't that cool?
After
Yeah.
the hangover.
Yeah. No, I'm sure it's quite controlled. And of course, you got to be over 21 because of the wine there. But they have a trip that is in Sacramento. It's near Coloma, and it's rated Class 3. So it's anywhere from beginning and experienced paddlers alike.
Oh, sounds fun.
Yeah, it says. And then they do a 1 day of chauffeured wine tasting, followed by the day of whitewater rafting down the Chili Bar run, including meat grinder, triple threat, and troublemaker rapids. That's
Boom.
awesome. Got to check them out. 800. It's called Adventure Connection. 800-556-6060 for more details, or visit raftcalifornia.com.
Cool.
Okay, so here's our first trivia question regarding Seinfeld. Remember Babu? Babu
Oh, yeah.
Bot? His brother does not like Snapple because it's too what?
That can be
Okay,
tough.
a tough one here. All right, he was offered a Snapple, and Babu, Bot's brother, said he didn't want Snapple because it was too what? All right, the first caller with the correct answer will win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Stay with us. You're listening to The Best of Investing, and we will be right back. All right.
Is that too sweet? It was too sweet, right? I don't know. I think
Oh, I mean, that sounds.
that's a pretty random one. That's pretty
That
specific.
was pretty random, pretty specific, yes.
That's interesting info on the S&P 500. So, were you? I don't know if we got off track. Are you leading up to another like a kind of bringing that
Well, I was going to talk. I had a couple things that we want to dive down a little bit more. I mean, it depends how
Good.
boring it was.
No, it wasn't. I don't think it was boring.
Okay.
It was good. I was just, what I'm asking is were you bringing that to like a certain point, or?
What I was going to do is tell everybody the results of the 7-year bull market and which sectors have done the best.
Okay,
good.
yeah,
Which is kind of
okay.
so that's a pretty cool
Perfect.
one.
Yes.
So we can go through them again and say, okay, which ones do you think were the winners and which ones were the losers?
Yeah.
Yeah, they made me source all that stuff. I had to go to the Wall Street Journal this time. U.S. News and World Report actually proved my statements. Love that. That was awesome. Can you prove it? What, am I wrong? Has gas gone down? Am I wrong? Am I wrong in that one?
No, but that's not good enough.
Exactly.
Yeah.
Not good enough.
All right. Is it ready? There we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Markov and Lou Batmale. When we get to the first commercial break, we ask this trivia question about Seinfeld. Babu Bhatt's brother does not like Snapple because it's too what?
I'm going to go too sweet.
Pretty close. He says, too fruity.
Too
Too fruity, if you remember that episode. When Babu was going to get deported. Anyway.
Oh,
Oh, that's right.
because he didn't get the mail, right?
That's right.
Yeah,
Very
exactly.
good. Okay. So, Lou, you got some statistics for us.
Right. Well, this is kind of interesting. Over the we've basically been in a 7-year bull market. So as we said before, it's been very volatile. The market's pulled back a lot, and everyone's been kind of looking for answers. And there's been different parts of the economy doing well at different times.
Mm-hmm.
When you stack all those things I talked about before, consumer discretionary, financial stocks, industrials, technology, healthcare, consumer staples, materials, utilities, and telecom and energy, what has done the best and what has done the worst since the 7-year bull market began in March of 2009. So this kind of shocks everybody when you really pay attention to it. The best performer,
I would guess that tech would be up top, if not the best.
no, it's fourth.
Wow.
Is that brutal?
Yeah.
Consumer discretionary. So again, everyone flooded to go buy toilet paper and toothpaste.
Target.
When the market turned around, and that's where it stayed mostly. So, but now this is kind of bizarre. This is going to blow your mind. The second one's financials.
The bank stocks.
So, but it's also purchasing stocks. MasterCard's in there, Visa's in there. A lot of those companies are in there as well. Industrials have done quite well. That's number 3.
Yes.
Well, it's part of the recovery, and everyone's making stuff all over the world and shipping it all over the place. Remember, I mean, it's not that hard to remember. I mean, big companies like think of a Caterpillar or John Deere. I mean,
Right.
3 years ago, it was hard to get a tractor for them within 22 months of delivery.
Really?
Like you ordered it, it took a while to get it. But that was a while ago. Now we get down to technology, Mark's choice. Number 4, healthcare. Healthcare, because the advent of Obamacare, as I mentioned. Consumer staples. That's back into the things you buy at the supermarket. Materials, utilities, which are kind of a defensive play against interest rates, which will get hurt if there's interest rates rising.
Yeah.
Right now you can get utility stocks maybe around 3%, maybe around 2%, some as high as 4%. But in the end,
Talking about dividends.
dividends. I'm talking, that's what people buy them. Then the last or second to last one is telecom. Okay, telecom
Because
is
rates have been going down.
AT&T and Verizon. Are places where people park their money when
Battling to zero, basically.
Right, and I mean AT&T I think pays over a 4.5% or 5% dividend right now.
Wow.
So that's why people buy it, and everyone uses the phone or uses their, at one time what iPhones were all on AT&T at one time, right? For the most part. And the last one's energy. Now that hurts a lot, but think about this over the last 7 years, right? So we had oil at what, like 142?
Right.
Now when was that?
2009.
About 2008, 9. Well, 2008 brought it down, so it kind of spiked up again, back up to 100, but now it's back down to 30. If you look at the 35-year average price of oil, inflation adjusted, do you know what the number is?
No.
$35.
Wow.
That's going back to like 1965, all the way through the price of oil.
Because for a while, oil was like $9 a barrel.
Right. For a long period of time. But I mean, you had the problems back in the 70s.
Yeah.
We had the problems in the mid 2000s. Everyone's talked about peak oil. The peak oil argument is losing more and more steam. Advent of Iran coming on board, the advent of us finding domestic oil here. There's oil around. It's just how much does it cost to get it? Yeah.
Exactly.
How much does it cost to get it? And the idea is that, people remember years and years ago, everyone remembering the car standards, how far can your car go in a gallon of gas?
Yeah.
And we're getting to average above 20 miles a gallon, going towards 30. Everyone talks about the companies that are doing that, which are Tesla or Honda's years ago and stuff like that. That's really changing the face of our economy, and globally it's changing things too. We're being more efficient with oil. One guy threw a stat out there one time. It took you an hour's worth of work in the early 1900s to earn 1 hour of energy at night.
Wow.
Because you used what,
Kerosene.
kerosene or whatever. That's how much it cost back then. So if you worked a day's shift, that's how much it cost you. So the budget oil now compared to what it is part of your budget compared to then. It was like an eighth of your budget was funding energy in your home.
Wow.
So that's really changed the
Getting
face.
a lot of candles.
So, but energy is commodities related. Materials are commodities related. That's what you're seeing, this boom bust cycle and things, and that's what people have to be aware of. I think people are afraid of recessionary pressures because of they think there's excesses. There's some excesses here in the Bay Area. We'll probably touch on that later on because Mark and you, Ed, are good responders to the real estate market out there, and that's probably where we're seeing problems. But out in the rest of the world, Tucson, Arizona, Omaha, Nebraska, we're not seeing these problems.
Right.
They still have foreclosures on the books they're trying to sell.
Yeah.
So, think of the economy, not necessarily your own microcosm. Because people in the Bay Area are nervous, and I know why, and it's because they're seeing the excesses out there.
Well, go ahead.
So Lou, you just shared with us the sectors of the economy that gained the most in the 7-year bull run. So obviously that's great information, but how does that help us predict what we should be doing as investors?
Okay, so that leads right into the email question we got, and this is right up your alley, is what do I change with my investments in this type of market?
Okay, so the first thing to know about this market compared to everything else is it's hard to find dividend or interest payments. Some bonds had a net negative return last year, especially in the high yield sector because the oil market crashed. And a lot of those bonds were affected by the fact that people can make their payments towards their bonds. But right now, I think everyone has to sit there and say, what has done well in my portfolio? The S&P 500 did well. Why? Some people wrote some acronyms last year. FANG, Facebook, Apple, Netflix, and Google were the best performing stocks. And if you own the S&P 500, those stocks went up. The index went up. That's a pretty focused bunch of stocks to go up to carry an index. So to your point, you look at these different sectors. I'd stay away from things that pay a high dividend payment if you think interest rates are going to go up. Hasn't materialized yet. If you think technology's gone up too much, then you pull away from it a little bit. The idea is to be a little bit balanced, and everyone has index swell. So if you had a 65% stock portfolio, 35% bond portfolio, chances are over the last 2 years your stock portfolio has done better than your bond portfolio. That being the case, it's time to reassess. How much risk do I want to take if I'm 40, 50, or 60 years old? Am I willing to have a 75% stock portfolio now because it's grown that way? Do I want to continue to ride the stock wave if I think there's going to be a recession? I, for one, don't think there's a recession on the horizon. I think a recession could be caused by lots of things. When I think of recession right now, I think it's going to be caused by some type of what we call a heart attack event, like Chipotle. They're having all these problems because of what's been going on with their restaurants. It might be caused by something like that versus this general meltdown or blow up of one certain part of the economy. That's the way it looks to me right now. So I would stay balanced, and technology and healthcare have really rocked it out of the park. So I'm a little nervous about that right now, I'd say honestly.
So if you're an index investor, do I stick with my so-called spider index funds for the S&P 500 or other index funds? Are there other index funds I can look at if I work with someone like you, Lou, that would be helpful for me to move over into maybe more sector-focused index stocks?
Well, on a broad scale right now, the thing you want to take a look at, if you just go to the S&P 500, and right now we've seen a complete devaluation of the small cap sector, maybe it's a time to start looking at small caps. They're down upwards of 10 to 15% over the last year in many small cap sectors. Also, I would say that value has underperformed growth by a large margin for the first time in several years. I'm talking about a 4 or 5% difference in owning the S&P 500 besides the Russell 1000 value. So I think that's an allocation opportunity where you sit there and say, maybe I buy some less sexy stuff in my portfolio because there's a chance it's undervalued. You look for stuff that's undervalued. I think some overseas markets are undervalued, but significantly. compared to the U.S. sectors, because the U.S. sectors are very popular around the whole world because we're so.
Which overseas ones do you like?
Right now, I do like a little bit of the emerging markets coming back. I would stay away maybe from Brazil and Russia, but look at other ones like India. Looks like a pretty good play right now. I think some parts of Asia will come back. I do think they're, no matter what happens, and sadly that attack in Paris derailed a lot of progress economically over in Europe.
Oh, yeah.
And I'll tell you, I think Europe's going to come back. I think they have to make a comeback because they have to get out of the banking mess they're in. So I think everyone should own a little bit of Europe right now. And you have to be patient. That's the big thing. You have to be patient.
Very good. Okay, we're going to cut to our second commercial break, and when we come back, we've got an interesting question here from Mark about the types of loans being requested from your company, and we'll get into Deal of the Week also. All right, second trivia question for Seinfeld. Before we do, we want to make a quick mention also to the Lesher Theater in Walnut Creek. You can see Pink Floyd. Well, not actually Pink Floyd. It's a Pink Floyd tribute band. March 12th, that's tonight.
Awesome.
At the Lesher Theater in Walnut Creek. It's a very nice theater. And then on March 26th, Led Zeppelin, baby.
We're there.
We're there. It's a tribute band to Led Zeppelin, but check them out at the Lesher Theater in Walnut Creek. All right, so here is our second trivia question about Seinfeld.
I'm going to get this one.
Okay, other than Jerry, who usually uttered the words, "Hello, Newman"? The first caller with the correct answer wins a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. On the TV show Seinfeld, other than Jerry, who usually uttered the words, "Hello, Newman"? Stay with us. You're listening to The Best in Investing. We'll be right back.
I think I know that one.
I have a guess, but I'm guessing it might not be the guess I'm guessing.
These are tough. These are very specific.
They are. I think because I know that you know everything about Seinfeld. So
These are unfair.
unfair ones. Yeah, there's another specific one next time. Selfie?
I know. I saw one of my clients today. He goes, "You look like a frickin' bum," and I'm like, "Yeah, I'm going on the radio too." He's like,
Okay.
He's like, "Are you
Bum
so
TV.
bum? Goddamn bum! Because you manage my money." I go, "No, not specifically."
My
So
beard,
funny.
my beard is so white that now
Yeah.
if I grow it, it just completely totally alters my.
I saw Gary Champagne at the gym.
Oh yeah,
He's a nice guy.
a great guy. Yeah, he's classic.
He's getting married, that rascal.
Yeah. So yeah, she's real nice. I see her running all the time, and he's funny, dude. He says that guy with the long hair is the best trainer inside the Bay Club. They get compared notes a lot all the time. The shorter guy, I forget his name, but he's they talk about notes.
With long hair.
Yes,
Is
yeah.
it Scott Salzhammer?
Is that it? He's kind of shorter?
Okay. Kind of really muscular.
Yeah.
Yeah. A lot of tattoos.
Yeah.
Yeah. That would be him. Okay, ready?
Red eye.
Here we go. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hunt and Lou Batmale. We asked another specific trivia question here about Seinfeld. Other than Jerry, who usually uttered the words, "Hello, Newman"?
I think I know this one. It's Jerry's mom. Right?
Yes! Very good.
Does Jerry's mom actually have a name?
Helen.
Oh,
Helen Seinfeld.
I was gonna go with Elaine. Gosh, I'm kind of upset now.
No, because Elaine wouldn't usually say that. But
No.
Very good.
That's
I
a
was
good one.
surprised you
Good
actually got that one. Okay, so Mark, we're going to get right into an email that we received for you that says, "Are you seeing a switch in the types of loans being requested than you were doing last year? Are the markets changing?"
Well, so my company is Pacific Private Money, located here in the Bay Area. We are a alternative source of real estate financing. We're basically a non-bank lender. We're kind of the plan B for a real estate loan when plan A is not an option. Plan A being conventional or bank money at 4 to 5%. Sometimes people refer to us as hard money lenders, although it's kind of a dated term. We prefer as a private money lender or a private loan originator. And our monies can be, anywhere from 8 to 12%. In the Bay Area, 9 to 10% is pretty much an average range for the type of loans we do, which are generally very fast to qualify, fast to close, and usually fast to get paid off too because he wants to pay 10% for money. But we're really there for the convenience of our clients. And we talked a little bit, Edward, about this last week about how there a lot of people when they hear hard money, they think they know what it means. They think it's the people in financial distress, the lender of last resort for people like that. And that used to be what many people in this industry were serving maybe 10, 15, 20 years ago, but really not so much today. It's we're really we really serve a different type of client now. Has the mix or has the type of loan demand changed over the last couple of years? Yes, absolutely. So I started out in 2008, and right when the financial markets melted down. So the first couple of years of my business were pretty lean. But I'll tell you, in 2010, 11, and 12, I was almost only doing loans to guys who were buying, fixing, and flipping real estate. That's where the biggest demand for non-bank financing was. Well, and why non-bank? Well, because most of those flippers and contractors couldn't get bank financing. They tend not to have great credit, and that's still pretty much true today. Is my best flipper clients who I love making loans to, they just have crappy credit. They just don't know how to manage their credit scores, and the banks won't touch them. But they're good loans, and now flipping activity has gone way down. Why? Well, the foreclosure wave has come and gone. Foreclosures are way down. They're right now back to pre-recession levels from the early to mid-2000s. And so what we're seeing more and more now is a different type of loan demand thanks to, or no thanks to Dodd-Frank, depending on what side of the table you want. For us, it's thanks to Dodd-Frank. I mean, as much as I hate government regulations just from a kind of a political standpoint, my company, Pacific Private Money, has really benefited from the Dodd-Frank financial regulations and reforms, which have really come down hard on the banking industry, on the types of loans and how easy it is to get a loan and what we need to do in order to loan someone money, i.e. we have to make sure that this person we're loaning the money to actually has the ability to afford the loan payments. That was something that really never existed before, because we all heard about the fog and mirror, loan programs in the early to mid-2000s. So we're now starting to see a lot of demand from people who just need, they can't get bank financing to buy a home, although they believe they will qualify in a very short period of time to buy a home. They'll get what we call a bridge loan for an owner-occupied or primary residence. And there's a lot of scenarios that are all a little bit different. In fact, when I talk about Deal of the Week, I'll give a couple of examples of loan requests we just got these last couple of weeks. So yes, the demand has changed, and it's actually changed in a way that I think is stronger for, well, at least my company, because our business model is all about making good loans that have safety and security features, because I'm using private capital. I have investors who invest their capital with my company expecting a high yield return, and right now we're paying about 8% on average to our investors.
Yeah, you can't just go and hope for a government bailout.
Right, that's exactly right. And those investors expect that I'm utilizing their money with safety and security features of those loans, meaning I'm going through title companies, I'm getting title insurance, I'm getting hazard insurance. Our loans really, for all intents and purposes, are identical to the kind that banks make. We use the same kind of documentation, the same kind of escrow services, the same kind of insurance. So really the only difference is, banks are really a lot tougher nowadays to qualify for a bank loan, whereas a private party loan through a company like Pacific Private Money, we'll listen to your story. The story actually makes a difference to us. The story matters, and if the story sounds credible and we can back it up with, there's still paperwork involved that, we do need to make sure you have an exit strategy, meaning, how are you going to pay it back? We don't want to make you a 10% loan and then you can't pay it back for, year after year after year. We want to, usually people, our loans pay back on average, between 12 and 18 months, or I should really realistically between 6 and 18 months is, I would say 80% of the loans we make get paid back. So we're seeing people with higher FICO scores, higher income, buying nicer homes through us in the form of these bridge loans, these temporary loans, while they qualify for bank financing. And that's something that's really different today. That really wasn't something I was doing many of in 10, 11, and 12. Again, mostly flippers. And now it's just serving that demand for capital that isn't being satisfied by the bank. So, I think it's a good thing. not that anyone enjoys paying 10% for money, but again, if you take a broader 20 or 30-year perspective on interest rates, we've just been really fortunate, and you kind of lose perspective if you look at the last 10 years where interest rates have been for mortgages between 3 and 5%. The 30-year weighted average cost of a mortgage is more like 6 to 8%. So it's for many people that initial sticker shock wears off when you have a friendly conversation about them. Here's all the great things about coming to a company like ours. We can do the deal fast. There are a lot less hurdles for qualification. It's really a fast, friendly, no fuss, no muss type of borrowing process for you. So again, if you're someone out there listening and you're looking to buy a home and you're struggling because you don't want to sell the home you're living in first before you buy the next home, bank has told you you'll qualify for 2 mortgages at the same time. A lot of people will resort to a privately funded bridge loan through a company like Pacific Private Money, and you get the home you want. You pay a little bit extra for it in terms of some fees to our company, but it's an option for you. It's a plan B when plan A is not available. And again, for more information, check out our website. We're at pacificprivatemoney.com, pacificprivatemoney.com, real easy. All of our contact information, names, address, telephone numbers, pictures, bios, anything you want to know about our company. We're about as transparent as you can get, and our clients like that about us, so give it a shot.
Well, I heard about one loan where this person had a decent credit score, but they had such a low interest rate on their low first mortgage that they didn't want to refinance that mortgage as well as needing some money for home improvement. They wanted to just get the home improvement loan. Well, a lot of banks won't do a second mortgage, and you're talking about $1 million house and a less than $100,000 first mortgage, and you want to borrow an extra $200,000 or $300,000. That's still going to be a pretty conservative loan, even though it's a second mortgage.
And here's a deal that we just actually closed this past week. So the borrower sold the home they were living in because they had a lot of equity, right? They wanted that money for the down payment. And then they leased it back from the buyer while they went out and found a target property to purchase. Now they believed, because there had been some time since there was a BK, a bankruptcy in their history, they thought they would qualify for bank financing. Well, it turns out many, if not most, banks and mortgage lenders today require 7 years to go by. Well, it's been 6 years since her bankruptcy,
right
so
there.
she's really close.
Yeah.
So she came to us and asked us if we would do a private money loan for her to help her buy her target property. And in fact, we really enjoyed making this deal because it was a brand new home that she went into contract for, and she gave the contractor the down payment. It's in Pittsburgh. I don't know if you've driven down Florida lately. They've got all these brand new homes that are going up, and so it came time. The contractor gave notice that it was time to buy the home, and she went to the bank, and the bank and her mortgage broker said, "No, sorry, we can do it for you next year, but not this year." So in a panic, she called us at Pacific Private Money. We were able to make her a loan. We closed this week. It doesn't have to. That example could be true if it were a foreclosure too. Bankruptcies, foreclosures, 7 years.
What was the loan to value that you did?
It was actually really good. I think we were at 60%. She had a pretty healthy down payment.
Yeah.
Again, she was really surprised that she couldn't get conventional financing. The other one, we got a call on late in the week from one of my brokers who refers a lot of loans. He tried to get conventional financing for this client and could not. And the client was a father and a daughter. The father's 90 years old. The daughter conducts all the business on his behalf, has a power of attorney for her father. Father lives in a home that's free and clear in the East Bay, worth probably about $1 million. And he was downsizing into an older folks' home, and so they wanted to sell the house, but it hadn't been remodeled forever. So they didn't want to leave money on the table. They want to remodel it. They want to borrow a couple $100,000, fix it up, and get like a market price for it. So they went to their bank and they looked at a lot of different options, and they all said, they all found out, no, you can't. I'm sorry, you don't make enough money. So he makes enough money to borrow about $200,000, between $200,000 and $300,000, which the loan to value to us to make that loan is like 20 to 30%. So we do have to. And the caveat is you can't go out. He can't go out and get like a home equity loan even nowadays.
No.
It doesn't exist like it used to. So,
Right,
for example,
yeah.
because he lives in it, it's a consumer loan. Even though he wants to use the money to improve the home to sell, and he's asking for a 1-year loan, I can't make him a 1-year loan because that's actually illegal now to make a balloon payment loan on an owner-occupied residence. So I have to make him a 30-year loan with no prepayment penalty, and we're getting the application now. But again, a good example of somebody who has a need for money, even if it's a short-term need. We can do the paperwork. We have to just abide by the new Dodd-Frank regulations.
And what's the interest rate charged?
Well, we haven't set it yet. Normally I would charge like a 9.9% rate, but because this loan to value is so low, I know I've got investors that I could go to who probably would make money available, in the high 8s to low 9s. So if I could hit an 8.9 rate for this guy, I would actually feel pretty good. I know that still sounds really high and maybe ridiculous.
He's not going to keep it that long.
Right, that's the point I made.
Yeah.
Look, it's let my investor make a little bit of money. You're going to probably pay it back as soon as you can.
Yeah.
How about an 8.9 rate? It's going to be a 30-year fully amortized loan with principal and interest, but you're going to make only the number of payments you need to make before you can get it on the market and sell it,
Exactly.
and don't leave any potential equity on the table.
Give out your information one more time, and then we'll get
Easiest
Lou to
way
give
is just to go to our website, pacificprivatemoney.com. Got lots of information on there for you, contact information. You can download some reports on what we do and how you can best utilize private capital like ours, pacificprivatemoney.com.
Also, give your phone number out in case people want to just.
We're
give
local,
a call.
415-883-2150, 415-883-2150. Leave a message.
And Lou, before we go to our commercial break, we forgot to get you to give your information out.
Oh, sure. It's I have a website as well. It's LOUIS and then BATMALE, LouisBatmale.com, and then phone number is 415-256-8970. We are doing some portfolio reviews for people right now who have questions going into the latter part of this year about where to go, what to do. So feel free to call and just say, hey, what do you think? And we give our honest opinion and hang up the phone and go from there, or give you some deep analysis, whatever you want.
You can always go to the Best Investing website if you can't remember Lou's website name.
Okay.
All right. I also want to make one last shout out here to Pacific Trade Exchange, barter to barter business, pactrade.org, or just Google Pacific Trade Exchange, barter to barter business. Good way to conserve your cash and do some business at the same time. All right, here is our third and final trivia question of the evening, of the afternoon, I guess, for Seinfeld. In the episode The Limo, now remember this is the one where George pretends to be O'Brien, the neo-Nazi speaker, just so he can get a free limo ride. The Knicks, the New York Knicks, were scheduled to host what NBA team that night?
Oh my gosh.
Well, there's only so many NBA teams.
Too specific.
Too specific, okay? The first call, there's so many Seinfeld.
Is there a
followers
governing
out there.
board? Is there a governing board on this? I want to go.
Yeah.
I want to file a grievance.
A grievance, okay. So again, in the episode, The Limo, now again, that's the one where George pretends to be O'Brien and Jerry pretends to be Murphy. They meet up with a couple of people. They're supposed to go to a neo-Nazi rally where George, being O'Brien, is supposed to make the speech, even though they're both Jewish. They're going to go to Madison Square Garden, and the Knicks were scheduled to host what NBA team? Who are they going to play against? All right, that's our question. The first caller with the correct answer wins a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Stay with us. You're listening to The Best of Investing. When we come back, we're going to have some more talk with Lou and Mark, and then we're going to cut out for the day with our thoughts for the day. All right.
How much time do we have left?
He's going to do the math.
Right now, we have 7 minutes and 41 seconds. That's a short one.
Well, I got a boring statistic that could end up being just part of the conversation. But
Because you already did your deals of the week.
yeah.
Okay, so that was in the third segment. If you want to have long.
This is on at noon or
Noon.
Noon, yeah.
We used to be on at 1, but they
Right.
changed a couple of years ago.
Or is your lead-in still that money, the food person, or no?
Yeah, we're a week before him now. I think we're just before him.
Does he do paid time or is he on?
I don't know. The old Gene Burns show.
Yeah.
I don't know. I don't know if they have to pay. I think that's was part of their syndication.
That's what. Yeah.
Which between me, you, and the lamppost, and Mark, I don't like this show. I think it's kind of boring.
Which one?
The food show, you know.
Oh yeah. He was on 810 though, wasn't he?
Yeah.
Yeah. That's what Mike Clary ended up doing, or the guy. Remember Mike? Who's the guy from KMBR in the mornings? He ended up doing the food show. KMBR. Well, Mike. You remember the old morning guy named Mike? Mike Cleary. Wasn't it Mike Cleary?
He sounds familiar. I mean, Gene Burns was the one for KGL.
Right.
He died. They got this other guy, his sidekick. Okay, you guys ready?
I'm just going to throw out a stat, and we can just go anywhere with it. If you got
Okay.
something to tie it with.
Sell. That's what go.
Here we go. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark On and Lou Batmale. Third trivia question. In the episode of Seinfeld, The Limo, where George pretends to be O'Brien, the neo-Nazi speaker, they're going to go to Madison Square Garden. The Knicks were scheduled to host what NBA team?
No idea.
I'm going with the Bulls.
The Bulls. That's right.
Nice.
Yes.
We're going to see Jordan. Okay. All right. Mark, you have a couple of statistics for us?
Well, I just thought it would be interesting to throw something out. So the stats are in for year-end 2015, and in California, there were 450,000, almost to the number, home sales, which were up almost 10% from the year before. So that sounds good, right? On the face of it, sales are up almost 10% year over year. $450,000 homes. 450,000 homes in California.
Okay.
So, what if I told you in 2005, in California, there were 750,000 homes sold.
Considering the way lending was going, I'm not surprised.
Yeah, that's a good point. Yeah.
But it's really interesting because you keep hearing the same kind of real estate information over and over again. Low inventory, even though we got super low mortgage rates, they're still now in the high to mid threes. But there's just not a lot of inventory out there, and people are finding it difficult to find the home to buy or to get the house in contract. But 750,000, and so what I guess the thing that just really stuns me is that there's a demand for more units than sold, right? If we sold 450, and where are all the new home developments? I don't get it. There's something that's kind of upside down and topsy-turvy with in a macro sense, with all the various components that make up the economy.
Because you still have an influx of people in California, right?
We still have a net immigration into California. Rents are skyrocketing. They're increasing at double-digit rates, and so far it hasn't slowed down, even though there's a prediction that in 2016 rents will not increase double digits. But then I think they had that prediction a year ago for 2015, and it didn't hold through. In fact, price appreciation for 2015 was 10% in the Bay Area. It was predicted to be 6%. Rents went up 12% there on average. Some markets more. It was predicted to be half of that. So the pundits, whoever they are predicting in 2016 that a home price appreciation on average is going to be closer to 6 or 7 versus double digits, and that rents will also go up at a slower pace. But we're not seeing any indication of that happening, and we still have a lot to go in terms of fulfilling the demand for housing unit sales. So it's baffling in many ways.
Well, isn't the stat out again that the amount of home ownership in America is still at a low number compared to, especially, 2005, 2007, of course, but just on a long-term national average, it's somewhere in the 60% range.
It is. It's in the low 60s, and there was a huge conversion of homeowners to renters during the foreclosure crisis. Millions of people, and that includes people who bought homes who really didn't qualify or didn't have enough income to keep the home. So there's a little bit of a statistical variation there. And again, I don't know what that number is. Someone may have done a research on it, but still, nonetheless, it's a significant drop in home ownership. And there are a lot of people who want to buy homes, even many millennials who the media likes to portray as they just want to live at home with mom until they're 40 years old. But realistically, they make the type of money. And I know I happen to run across quite a few millennials who say, I'm looking to buy a house. I
Right.
just can't quite afford it right now, but I've got a down payment, and if housing prices weren't as expensive and hard to get as they are in the Bay Area, I'd be in a home right now.
You know, the biggest problem I have right now is I meet a lot of people who are in their retirement years and they're sitting there struggling about what to do housing wise. And a lot of them want to go buy another house. I said, well, are you downsizing? Or what are you doing? Are you moving from a place like San Mateo and going out to Tucson, Arizona, like I mentioned earlier? Or are you going to go somewhere else laterally in the Bay Area because your family's here or whatever? And it's really a struggle for everyone because when you move nowadays and these price increases happen, you talked about, your homeowner's taxes go up.
Right.
And that's a big budget problem. And when you're on Social Security, which didn't go up last year, higher taxes on your home don't ever go down. It's like a tattoo, a really bad tattoo. It sits there.
I've got one of those.
It sits there and it just rots on you the whole time. You're like, oh my goodness, what's going to happen? And I think this is the part of housing that people don't understand is these fixed costs that never go down. And I think it's also prevented people from buying. They're like, wow, we can't afford the long-term cost of owning a house. It's kind of a struggle, I think.
Well, with all the positive things that are happening in real estate in terms of low mortgage rates, and there's still what you can buy for the income you make is still a very strong amount. In many markets, we joke about Marin, San Francisco, and Silicon Valley, that whole peninsula belt of homes that are just priced astronomically. But there are other areas outside of in the immediate Bay Area that neighborhoods where there are homes that the values are affordable, but again, it's just the volume. There's not enough new home sales going on. And so, one report I'm saying we've got the weakest home buyer demographics in 15 years.
Whoa.
Basically saying that, meaning that we don't have the down payments that we used to have. The incomes are there, but home prices are so high that the ability to qualify with the right down payment just isn't there.
Well, if you pay a lot of rent, it's hard to save a lot of money.
Yeah, that's
That's
just
a problem.
So that points to, well, are we at a housing bubble? What is that going to trigger the next cycle? And again, I don't know what's going to trigger the next cycle, but it's certainly not a overabundant supply of housing, and it's certainly not from interest rates going up.
Guys, we're gonna have to cut out here. Mark, give out your information one more time.
So Mark Hanf, Pacific Private Money, pacificprivatemoney.com.
And Lou?
Lou Batmale, 415-256-8970 is the number, or just LOUISBATMALE into Google. You'll see me.
Very good. Okay, here's our dying thoughts for the day. Now, the thing most people are afraid of is public speaking. Next is dying. That means that at a funeral, the guy giving the eulogy would rather be in the box than out of the box. Okay, and Woody Allen said, "It's not that I'm afraid to die, I just don't want to be there when it happens." All right, tune in next week to The Best of Investing. We're going to be giving away more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Good. Good job, guys.
Now you get to go to bed.
I know, I gotta.
You didn't scooter here, did you?
No, because I can't. Oh, you can't. I get this operation thing. I'm gonna have to have more surgery or something.
Oh, sorry.
Yeah.